Hello everyone, my name is Ranti Retno-Wulan from Act 23A Class NPM 234122021. Here, I will explain about intercompany acquisitions and investments in other entities' standard costs. What is acquisition? Acquisition is a process when one company takes over ownership of another company, either in part or in whole. For example, PTA buys 80% of PTB's shares. This is an acquisition with control. TA buys 25% of PTC's shares. This is a significant investment, but not yet controlling. Types of intercompany investments. 1. Minority investment, 0% to 20%. Recorded using the cost or fair value method. There is no significant influence on the invested entity. 2. Significant investment, 20% to 50%. Use the equity method. Investors influence financial and operational policies. 3. Majority ownership, greater than 50%. Investor controls the entity. Financial statements must be consolidated. Why do companies invest in other entities? Business diversification, supply chain control, operational synergy, long-term strategic investment. What is standard cost? Standard costs are predetermined costs for the production of goods or services, based on assumptions of efficiency and market prices. Usually used for raw material, direct labor, factory overhead. Purpose of using standard costs: setting the production budget, control actual costs, assessing operational efficiency, analyzing cost variances. Types of variances in standard costs: variance in raw material prices, variance in raw material quantity, labor rate variance, labor efficiency variance, fixed and variable overhead variances. Variance analysis helps management to make better decisions and prevent waste. When does an investment not need to be consolidated? Answer: if a company only buys a small portion of another company's shares, then not all of the investment has to be consolidated. Depending on the size of ownership. 1. 20% ownership, no significant influence. Use cost or fair value method. 2.20 50% ownership, there is significant influence. Use the equity method. 3. 50% ownership, there is control. Use consolidation equity methods. If the company has significant influence, 20 to 50%, then investments are recorded at initial acquisition cost. The value is increased or decreased according to the profit/loss share of the associated entity. Example: PTA owns 30% of PTB's shares. PTB made a profit of 1 billion Indonesian rupiah. Then PTA recorded investment income equals 30% times 1 billion Indonesian rupiah equals 300 Indonesian rupiah million. Investment value increased by 300 Indonesian rupiah million. Benefits of this method represents real relationships between entities, not as complicated as consolidation. Still reflects profit contributions on the USO. And overall, we have discussed 3 key strategies in the world of business and accounting that support corporate growth and efficiency. 1. Acquisitions between companies. Acquisitions allow companies to grow rapidly, either by capturing new markets, reducing competition, or combining resources. With more than 50% control, the parent company is required to fully consolidate financial statements to provide stakeholders with a complete picture. 2. Investments in other entities. Companies do not always want to fully control other entities, but they can still invest. These investments can be significant influence, 20% to 50%, accounted for using the equity method, or minority investments, less than 20%, using the cost or fair value method. The purpose can be to diversify a portfolio, access technology, or build strategic partnerships. 3. Standard cost. Standard cost is an important tool in planning and controlling production costs. By setting ideal costs in advance, companies can monitor and analyze variances between expected and actual costs. This provides insight into operational efficiency and allows for continuous improvement in the production process.